Okay, we'll go straight away into Gopal's question. The question is about rebalancing of a portfolio. We have been reading various articles justifying, refuting, explaining, and finally confusing us all about the current bull run. Absolutely correct, Gopal. Absolutely correct. It's all in the game and normal. True, that too is correct. You advise us in general, if we were to rebalance our portfolio, we do it once a year. I had already done it a few months ago once. But this bull run is now happening, seems extraordinary. Present PE is ruling somewhere near 40. Even if we were to believe a V-shaped recovery, the economy may come back to situations just before COVID crisis hit. Historical PE ratio for the Nifty is too high, even if there is recovery to pre-COVID status. Is it advisable to rebalance the portfolio at this juncture again within a few months when I had rebalanced last? If yes, what is the prudent portfolio allocation in the present situation? Some of us have added 5 to 10% into gold along with debt and equity. Excellent question, because where rebalancing is concerned, many times our mind plays tricks on us. We go using common sense parameters for rebalancing. Like, okay, the index might have hit about 25,000 in the COVID, in the worst day, I think it was 23rd March, if I'm not mistaken, or 25th March, one of those dates, when the index fell to 25,000. Today we have 49,000. That's almost double in a span of well under a year, about 9 to 10 months. So that begs the question, should we rebalance, and should we rebalance again and again? Now, Gopal's other question is, there are so many reports. He puts it beautifully. He's drafting things better than I draft. We have read so many articles justifying, refuting, explaining, and finally confusing us all about the current bull run. Gopal, I wish I could write like that. The point is, you are right. You are right. But once again, let me tell you, none of this is unique. It has happened before many times across 4 centuries. There is one fundamental rule in investing, and especially in stock market investing. No bull market lasts forever. No recession also lasts forever. No boom lasts forever. No recession lasts forever. Whenever a recession or a boom lasts longer than normal or turns out to be stronger than normal, things get more dangerous, they do not get more safe. So that is the basic foundation upon which we have to analyze the current market situation as your question. So let me refocus again. No boom lasts forever. No recession also lasts forever. And building on that, the longer a boom lasts and the stronger or crazier, whichever way you want to put it, the stronger or crazier it is, the more dangerous it is. So on this foundation, if I'm to turn to your question, Gopal, we have a very recent precedent. And the recent precedent was, relatively recent I'm saying, the 2003 to 2013 almost bubble in real estate prices. I still remember walking into a lawyer's office in 2012, maybe a year or little less than a year before the whole real estate boom ended. And that lawyer is someone who specializes in real estate, my very good friend and a former faculty on this course, Advocate Krishna Prasad. And I had gone to meet Krishna Prasad with another client to brief him about that client's issues. We had finished the meeting, and as I was turning to get up, he told the client, if you don't mind, I have a 1-minute question of Mr. Kulaso. And he asked me, what do you think of this particular present scenario in the real estate market? And I told him, Mr. Prasad, according to me, in the real estate market, we have crossed over from bull market territory to bubble territory. We have crossed over from boom to a bubble. And he was very taken up with that sentence, so he immediately took a pen and paper and noted it down, that we have crossed over from boom territory to bubble territory. 10 months later or so, nobody knew, I could not predict, but the whole situation was unreal. And it is something like the unreal situation that we are living through today in the stock market, of course, this time. So now, if we are having a price earnings ratio approaching 40, when 27, 28 have been the previous levels of the NSE 50, at which we have had rather serious corrections, we are at 40 and it appears to be very strong. Then, if it appears crazy, it appears strong, it appears long, it appears not justified, the simple question is this dangerous? Now, if we agree that it is dangerous, then what is the purpose of a rebalancing strategy? The purpose of a rebalancing strategy is to ensure that we slightly prune portfolios when it is dangerously high, and we invest more than normal when it is rewardingly or enticingly or attractively low. So if this is our basic premise, then we should definitely rebalance. Now, how do we rebalance? We have to rebalance according to a rebalancing policy. We should have a very clear-cut policy and stick to it. Now, very often, we rebalance by time, and that has come to occupy our minds. Only rebalancing by time. Rebalancing at intervals of 1 year. Why 1 year? Because in India, as well as many of the advanced countries, 1 year is the trigger for long-term capital gains in stocks or equity. So to be more tax efficient, they say 1 complete year. But rebalancing is not that. Rebalancing is based on 2 possible triggers. One is time and the other is value. And value is expressed as percentage of the index from the time you last rebalanced to what it is now. For example, if I bought quite a bit at 25,000 index and the index screamed upwards to 40,000, and I considered it that's more than a 50% increase, so I rebalanced once at that time. But now, instead of either stagnating or coming down, from 40,000, it has gone to 50,000. So from 40,000 to 50,000 is a 25% increase from 40,000. There is absolutely no harm in rebalancing again, even if 1 year has not passed. So please understand this, that rebalancing can be by time, rebalancing can be by value. The important thing is that if you use the value trigger and the index is 50,000 and you rebalance at 50,000, then if the market either crashes or remains stagnant, let us say, if there is no real further call for you to rebalance by value, then your next rebalancing can be 1 year from the last rebalancing, not 1 year from the time you originally rebalanced, but 1 year from the time you rebalanced by value. Let's give some dates to it to make it clear. Supposing, we'll take the current scenario. I rebalanced about, let's say, 3 or 4 months back, maybe in September. In September, I have rebalanced. And from September to January, the next year, it has gone up again by 20-25%. Now I rebalance in January, this month. Now, if there is no further rise of the kind that we have seen that justifies rebalancing by value, then my next rebalancing by time can be only in January of 2022. It will be 2022. I hope this part of it is understood. Just because I rebalanced in September once I need not have rebalancing by time in September of 2021 again. Since I am now rebalanced in January 2021, my next rebalancing can be in January 2022. Now, one more important point about rebalancing by value is, supposing you want to rebalance at every 10% movement in the market. Please understand that there is no hard and fast rule that 10% if I rebalance when the market falls, I should also rebalance by the same 10% when the market rises. No, you have to have a policy. The policy can be, since stock markets tend to give good returns, and since stock markets in the long run, the longer the period, the more likely they are to go up. You can have a policy something like this. On the downside, I will rebalance every time that I have a 10% opportunity from my last rebalancing. But on the upside, I will only rebalance if there is a 20% rise. So a 10% rebalancing trigger for a fall in the market and a 20% rebalancing trigger for a rise in the market is an excellent rebalancing policy by value. I hope I'm making sense here. So, right. Gopal, you can come back and tell me whether I have addressed your question.
Yeah, sure.
Okay. In which case, I will continue.
My main contention was to reduce risk rather than earn profit.
Yes, and if there is a substantial upside from the time you last rebalanced Gopal, I think you should do it again.
Yes, clear. Right. It's clear.
Right. Thank you. So we go to the second question, and the second question is an excellent question once again, and all good questions today from my old student now in happily hiding in London, Pavitra Nayak. And Navin, I think Navin Kamath and Pavitra Nayak. Navin Kamath is a husband. Pavitra was my student several years ago, working in London at the moment. Now, she has a question on an aspect of the Franklin Templeton issue. We will tackle another aspect of it when Deepak asks his question later on in the session. Now, Pavitra's question is very good because it allows me to bring clarity to an issue, and most people do not have clarity here, as this very question shows. A person argued that if Franklin Templeton was invested in lower graded bonds, which is what I understood was the root cause of this debacle of its funds winding down, what sort of due diligence is an investor supposed to do on mutual funds before investing? The argument was me trying to explain that not all mutual funds are harmful. And the person asked me, well, you said that about ultra short funds, and now it's winding down because of the underlying bond illiquidity. Was it possible to have predicted this scenario with these sets of mutual funds? What is our lesson learned here? That last bit I really love, because all my interns and former students, I really wish at the end of any new occurrence, they ask this question: what have we learned from this? How can we not repeat these mistakes? That's a brilliant question to ask from Pavitra. So let me tackle this one by one. I will first take one sentence from the middle of this question and we will analyze it. I'll read that sentence again. The person argued that if Franklin Templeton was invested in lower grade bonds, which is what I understood was the root cause of this debacle, what sort of due diligence, etc., etc. The first point that I want to tackle is that the Franklin India Ultra Short Bond Fund was not invested in lower grade bonds. This is something that is difficult to digest, but it was not invested in lower grade bonds. It had three types of bonds in its portfolio: AAA, AA, and A. When you look at the ratings and what they mean, AAA means highest safety. AA means high safety. Single A means adequate safety. Highest safety, high safety, adequate safety. Let's understand this. The crisis is not because Franklin Templeton invested in low rated bonds. For something to be low, it should be below A. It should be triple B, whatever it is. So let's understand very clearly that the crisis was not because of the investing in lower grade bonds. They are not lower grade. The worst bonds have had what are called adequate safety, and they constituted some portion of the portfolio. But the vast majority was in high safety and highest safety. In fact, Burton Malkiel, in A Random Walk Down Wall Street, he says, if you have sufficiently wide diversification, 500, 1,000 bonds, for example, and each having a small, tiny percentage, less than 1%, even a junk bond fund will be fine. And I will deal here with the Franklin India Ultra Short Bond Fund, because that's the largest of the wound up funds and probably the one in which most people have invested 9,000 odd crores in that fund. So it is not a junk bond fund. And Burton Malkiel has said that even junk bonds would make sense. They would have a good risk reward relationship if they are sufficiently diversified. So, like I said, what was the mistake on the part of Franklin Templeton? My analysis is that the mistake was a mistake of tenure. Okay, all these jokes like Sharpe ratio, blunt ratio, Macaulay duration, all that they are being shown up now for the jokes they are, because you can do all your fine calculations and come out with a so-called Macaulay duration that is supposed to be 3 to 6 months, and you can get stuck if one black swan event started. Now, the mistake of Franklin Templeton was that they combined two risks in an ultra short bond fund. One risk, if we may put it that, was to go for A and double A. But actually, when you look at it, it would have been a risk if all their funds were in 1 or 2 A-rated bonds, single A-rated bonds. But actually, it was a very well diversified portfolio. So whatever risk there could have been because of an A-rated bond or a double A-rated bond was neutralized by diversification. That was not the problem. The problem was, to this issue, they added one unnecessary issue by going for long tenures. 1 year, 2 year, 3 year, 5 year bonds. Although they had certain clauses of early redemption, put options, call options, all that. Yes, I don't deny that. But still, these were long tenures. If you see their maturity profile, they had long tenures in what was essentially an ultra short bond fund, where your tenure should normally not exceed an average of 3 to 6 months. So if you're talking about 3 to 6 months, which is the SEBI definition, then the average is about 4.5 months. Now, it is not that each and every one of them should be hover around 4.5 months. You can go for 7 months, you can go for 8 months, but not 2 years or 3 years. According to me, this was the mistake, and this provided the grounds for a liquidity crisis when we had some black swan event like the COVID-19 pandemic. So this was the main problem. Now, I will prove to you one by one that this is not because of lower grade funds. Overnight, yesterday and today, all investors have received an email from Franklin Templeton, and I'm going to read 1 or 2 sentences from it. The inflows received across 6 schemes is nearly 41% higher than anticipated in the maturity profile published on April 23, 2020. April 23 till today, we have finished almost 9 months. So I told you it's a liquidity crisis. A liquidity crisis gets solved by time. 9 months have passed. A credit crisis ends in default. Understand this. A credit problem will end in default. A liquidity crisis gets solved with time. So what they are saying is, in the ultra short, in all the 6 funds, not in the ultra short, in all the 6 funds, in this period of 9 months, because redemptions were not possible, investors had to sacrifice liquidity. What inflows have come in are 41% higher. That's a significant amount, 41% higher than what has been shown in the maturity profile. They are ahead of their schedule, maturity schedule, thanks to prepayments. Second thing that they have said, it will be pertinent to note that the rupees 13,789 crores received since April 24, 2020. Sorry, I'll read it again. It will be pertinent to note that of the rupees 13,789 crores received since 24th April 2020, slightly more than half of this amount has been received from securities rated A. Let's pause here. Slightly more than half of this 13,700 and odd crores, that means something like approaching 7,000 crores, 6,700, 6,800 crores has been received from securities rated A, not even AA, followed by securities rated AA. Much of this cash has been generated from securities which were unlisted. That was an accusation. Some unlisted, unheard of, or where Franklin Templeton was a majority holder. The accusations were you have put in unlisted securities, you have put in securities where no other mutual funds had invested, only you had invested. Why did they do this? Because in Franklin Templeton, while you may have one glamour fund manager like Santosh Kamal, I know a little bit about how Franklin Templeton works, including I have been to their head office a few years back when we had a personal function in Bombay. Both Reggie and I have been there. We have talked to, we were not interested in the equity fund managers. There's nothing much that they can teach us. But we had a very good session with the bond fund managers. And there I came to know that while there may be a head of the bond fund team, there is a process of due diligence. The selection of a security has to pass through a vetting process, and that vetting process can be pretty strict. So nothing works on the whim of one person. One person may be put there as a leader and he may have certain glamour. It may be that person who will go for the press conferences and his photo may come in the various media. But there is a process. So even if you are picking a bond which is unlisted, or you are picking a bond which only you are investing in, there has been a ground on the part of Franklin Templeton to believe that yes, this bond is worthy of being in this particular portfolio. So that vetting process has happened. So in 9 months, please remember, without Franklin Templeton being able to take any active measures, not one single active measure, the fact that 13,700 crores have come in, the fact that almost all the debt has now been wiped out except in one fund, and that too, it has reduced sharply. It shows that this was not a credit issue. And the most important thing is, if you come back to the Franklin India Ultra Short Bond Fund, in this Ultra Short Bond Fund, if you see, from the date of winding up, there has not been one single default as far as I know. Leo may correct me if there was any default in the portfolio here. There was no default at all. I'm sorry, there was no default at all as from the date of winding up. And earlier, in the case of Vodafone, the Vodafone bonds, there was no default. Franklin Templeton had taken the precaution of writing down the value of the bonds to zero because of the Supreme Court judgment that went against the telecom companies. This was the event. This was the event that triggered a re-rating of those bonds all the way down to zero, because they believed that in view of the Supreme Court judgment, Vodafone is not going to be able to pay a single rupee to its creditors. But what happened in June and July was not just the principal, but also the entire interest was repaid by Vodafone. So once again, it was not a credit issue. Once again, it was not a credit issue. It was not an issue of low-rated bonds. It was not that. But what was the issue? The issue, and where Franklin Templeton is at fault, is in a fund called an ultra-short bond fund, in another fund called a low-duration fund, where the names of the fund connote liquidity, anytime liquidity, at 1 working day's notice as per current norms. In these funds, what was promised to the investors in terms of liquidity, you failed to deliver. There is no doubt at all about this shortcoming on the part of Franklin Templeton. This is the mistake that they have done, for which they have had to pay quite a heavy price in terms of loss of reputation and also significant fall in their assets under management. So this definitely I would fault Franklin Templeton, not in the choice of the portfolios. The other thing is, let us come back to another point that is related to this. In October 2017, if you want the exact date, 6th October 2017, SEBI came out with a circular about categorization and rationalization of mutual fund schemes. Remember the date, or at least the month is enough. October 2017, this exercise was undertaken. The purpose of the exercise was, there is so much of confusion in the categories and types of mutual funds that we have. Therefore, we want to make things easy for the investors, and therefore we are now going to have very fixed compartmentalization, both in equity as well as in debt. Now, this operation of categorization and rationalization by SEBI, which was started in October 2017, it ended, or it was implemented by the middle of 2018. Remember this date, June 2018. So October 2018, we start the process. June 2018, October 2017, we start the process. June 2018, about 8-9 months later, we have finished the process. Now, the winding up of the funds took place in April 2020. Franklin Templeton, SEBI, the trustees of Franklin Templeton, the various inspectors and auditors who inspect the books and the other things of Franklin Templeton, they had something like 2.5 years from the time SEBI first started talking about categorization and rationalization. Okay, they had 2.5 years to set things right. That is ample time in a debt fund. Secondly, even from the last day by which you had implemented these things, which is 30th June, you had more than probably 1.75 years, 1.75 years to set things right. But Franklin Templeton did not do this. There was ample time for them to do this. They did not do this. What they should have done was, okay, now there are categorizations. SEBI has defined what is a liquid fund. SEBI has defined what an ultra short-term fund is. SEBI has defined what a low duration fund is. Now you have a definition of an ultra short-term fund, and we have in our portfolio a fund that calls itself an ultra short bond fund. Won't investors get confused? Won't investors think that when we call a fund ultra short bond fund, investors will definitely think that this is a fund that falls within SEBI's categorization of an ultra short bond fund? But in the Franklin Templeton portfolio, the ultra short bond fund, the fund that fell within that definition or category, was an entirely different fund called Franklin India Savings Fund. The Franklin India Savings Fund has remained till today the genuine ultra short bond fund. Your actual Franklin India ultra short bond fund was in a different category where the tenure was not what should be in an ultra short bond fund. So when Franklin Templeton knew and knew 1.5 to 2.5 years before the winding up event that there is a mismatch between the name of 2 or 3 of our funds and what investors may perceive in terms of safety as well as liquidity, I feel they should have taken some steps for corrective action. They should have either changed the name of the actual ultra short bond fund or then made the Franklin India Savings Fund the ultra short bond fund so that there is no ambiguity there. But SEBI failed to detect this in its 100 inspections and it's sending its teams of auditors. Franklin Templeton AMC did not do this, and according to me, that is a failure on the part of the AMC. The Franklin Templeton trustees, who are supposed to look after the interests of the investors, they should have done this. They did not do this, and there are various teams of inspectors and auditors. I do not know what they are auditing when they go to inspect. When we are talking about bond portfolios, the first point on their inspection should be, do the portfolios justify the objective of the fund? Is there any kind of dissonance or discord or some kind of discrepancy between the name of the fund, the objective of the fund, and the portfolio that has been created to meet that objective of the fund and reflect the name of the fund? This is the first thing that people have to look at it. Okay. So now coming to a question of Pavitra's. She has asked one question in that paragraph. Could this have been predicted in advance? Now, this is an easy question to answer. It could not have been predicted in advance. Why? I asked the question, I flipped the question. Could COVID-19 have been predicted in advance? We are now in January 2021. Let's travel back in time exactly 2 years. 2 years is not a long time. Let's travel back in time. We are in January 2019. In January 2019, could anybody or did anybody predict COVID-19? So we have to reflect on this. Okay, there will be black swan events. When black swan events happen, there will be consequences in 1 or 2 areas, whether it is in individuals or economies or countries or institutions or mutual funds or investment portfolios. Somewhere something will happen. They will be affected. And so in India, the 6 wound up funds of Franklin Templeton were affected. They were affected not for reasons of credit, they were affected for reasons of liquidity, for reasons of tenure. In 2 or 3 of those funds, like the Templeton India Income Opportunities Fund, the Franklin India Credit Risk Fund, the Franklin India perhaps Corporate Bond Fund, or whatever those other fund, Dynamic Accrual Fund, I'm not so sure. But when you have something like the Templeton India Income Opportunities Fund and the Credit Risk Fund, I have no problem if they were affected, because their very names suggest that, number one, they are long-term, minimum 3 years or above. And number two, they are going to deliberately get into risky investments in an effort to give the investors a higher return. But when you have the word short or liquid in your fund name, you indirectly make a promise of liquidity. You wind up a credit risk fund, you shut people out of liquidity, I have no quarrel with you. If I have gone into the credit risk fund, I should be prepared for those consequences. The only objection there can be, you call it an open-ended fund, which means it should be available there for daily sale and repurchase. Now you have wound it up. Okay, there is some merit in that argument. But having said that, we took the risk and risk has occurred, and risk need not always be in terms of value. Risk can also be in terms of a liquidity risk. It can be a liquidity risk. So Franklin Templeton can argue the case, the investors can argue the case, both would have merits. But my humble submission is that when you call a fund ultra short term, low duration, short term, the moment ultra, short, liquid, low duration, the moment these names appear in the name of a debt fund, the one thing you have to ensure is that under any circumstances, we do not close the funds. But here, thanks to mainly the liquidity mismatch, the fund was forced to close this and shut investors out for liquidity for the last 9 months, or maybe another 1 month, 10 months. And we hope with this things end and there is some good news on the horizon. I'll answer that during Deepak's question. So coming back to Pavitra's question, which is very good to analyze, I'm afraid that this could not have been predicted in advance. The ultra short bond fund has been in existence for about 16 years, at least 2005 from the best of my knowledge. It has passed through many crises, including the global financial crisis. Don't forget, there was no problem with it. Then there was a currency crisis later on. There were 100 crises. There was also a very serious debt crisis in India that has started in 2016-17. Nothing happened there. But COVID-19 and the lockdown and the fact that there was a lot of corporate debt, large corporates had also invested in this because it was a very popular fund, the ultra short bond fund. So when corporates put in their huge redemption requests, well, something had to crack, and it did crack. So I'm afraid it could not have really been predicted in advance. Even Franklin Templeton could not have predicted it. That's why they had to take this emergency measures. So coming back to the part of your question I like the most, what do we learn? Let's come to the learning now. One very deep lesson that I have learned from this crisis is that sadly, this is really sad, mutual funds only preach about consistency and long-term vision. In practice, they make constant changes. After some time, in an ultra short-term fund, you will have certain securities that have a long term. They will have a fund like the dynamic asset allocation fund, which started back in 2002 with Kothari Pioneer as an asset allocation fund mixing up a liquid fund and an index fund. And that is why we poured money into it. But they have made repeated changes and spoiled the whole thing. I want to ask Franklin Templeton just one simple question. You took over the fund from Kothari Pioneer. Actually, it was first Kothari Pioneer, which changed to Pioneer ITI and then to Franklin Templeton. If you had remained true to the original strategy of the old fund, which had its debt portion in a liquid fund and its equity portion in a nifty index fund, would you have had a problem in what today you call the Franklin India Dynamic Asset Allocation Fund? Today you have a problem. Long-term investors have seen their portfolio affected by 16% on one day, thanks to the investment in the FISTIP. Why? Because you made changes. Because you have preached consistency, but you yourself have been inconsistent. You have made too many changes. So if a good fund like Franklin Templeton, and let me tell you that I've had a long relationship with Franklin Templeton, it is a good fund. In several ways, it is far better than a number of other funds. In fact, since this is a closed group, I hope they are able to come back. If they are able to repay all their investors and they have learned their lessons, that's the theme of Pavitra's question. What can we learn? Franklin Templeton has gone through a very intense education process, let me tell you, in the last 10 months. Now, if they learn and they come back, and in the process, they are able to pay people off well, then I hope they can continue business, because their processes and they are always being reasonably investor friendly. Very high level of investor service, which I've not seen in most other funds. I can tell you that. The distributors in this group may agree with me. So, unfortunately, a good organization was damaged here in this whole thing. So, the first lesson to learn is that unfortunately, you cannot depend on consistency in a fund in the long run. Therefore, what should you do? What lesson should you learn? The lesson that I would say is you have to uh, take back control. You have to take back control. It is so easy to say. It is so easy to say that if there is a change in the fundamental attributes of a fund, they will advertise in the papers and they will give you a nice advertisement saying all those who are not satisfied can exit the fund without an exit load. I'm afraid that's a joke. That is rubbish. When they made their first change in the Franklin India Dynamic Asset Allocation Fund, our investors had already been there for several years. Yes, they can exit without an exit load. But is Franklin Templeton going to pay the taxes that are going to arise because they exit? What about the capital gains and other taxes? So what happens is many times when you get into a strategy which you think is a long-term strategy, but that strategy does not remain long-term because of changes made, the inconsistency of the mutual fund, the investor ultimately suffers. The investor is caught between the devil and the deep sea. If I want to exit, I have to pay the price of, it's not tax efficient. Therefore, one of the fundamental and most important lessons to be learned in this episode is that we have to take back control from the mutual funds. Mutual funds have to be, after this, viewed by an intelligent investor, as only a utility or a convenience. Just like we have our electric supply, we have our water supply, we have our internet connection. Internet is a utility, the most important. I know several young people who can live without water, but they can't live without the internet. So we need the utilities, we need conveniences, and mutual funds are going to be a very good convenience. But we have to take back control. How do we take back control? We take back control by being very good followers of John Bogle, by seeing where we can shift more and more to passive strategies. Every mutual fund person that comes to my office, again, I'm going to harp on only one thing. I want bond index funds. Okay, we have got some stock index funds, and there is a slow shift now towards stock index funds. I hope that continues. But now we want bond index funds, which will track a particular bond index so that we are spared the inconsistency and frequent changes made by the bond fund managers. In an stock index fund, nobody can make changes. You can close the fund. I agree that you can close the fund. One day we don't want this fund, we will close the fund. But you cannot make changes. You cannot make changes. You cannot substitute one thing to another. If you say Nifty, it has to be the Nifty stocks. You cannot go for a larger index, a Sensex, or any other type of thing. If you take even what happened to an old fund, the first fund in India that came out with an index product based on the NSE 500 index, that was Benchmark Mutual Fund, more than a decade ago. Benchmark Mutual Fund had a NSE 500 index. What happened to Benchmark? Benchmark was swallowed by Goldman Sachs. But when it was swallowed by Goldman Sachs, the NSE 500 index fund remained the NSE 500 index fund. Then Goldman Sachs decided to give up the mutual fund business. It went to Reliance. From Reliance, it went to Nippon. When it went from Goldman Sachs to Reliance, a change happened. The NSE 500 index fund now became a Nifty index fund. But although there is a difference between the NSE 500 and the Nifty, it remained at least an index fund. And even in the NSE 500, the Nifty was probably accounting for something like 80-85% of its value. So the basic character remained in place. That was because an investor opted for the index fund. We had a large number of investors in benchmark, even via SIPs. Almost none of those SIPs have stopped as the changes took place. First change to Goldman Sachs, second change to Reliance, third change to Nippon. Because, okay, instead of a 500 index, you're investing in a 50 index. But the Nifty is all right. Today, it's all right as an investment avenue. So we have continued them. There was no other fundamental change that provoked us to advise investors to liquidate their holdings or to stop their SIPs. Because the basic premise there was that it is a passively managed index product. So I think that we should agitate for similar passively managed bond products. There are any number of bond indices. So we should have a liquid index fund, an ultra short term index fund, a low duration index fund. If these are related to a particular index in that space, then you can invest with much more confidence, knowing that the fund manager does not have control over these kind of subjects. The fund manager does not have control over some of these aspects. They cannot monkey around. They have to follow the index. So that would be, in my opinion, the most important lesson that we can learn. Until then, I will return to index funds on the equity side and liquid and ultra short term funds on the debt side. You can continue investing in ultra short term funds because the rest of the ultra short term funds in India, including Franklin Templeton's own Franklin India Savings Fund, which is an ultra short term fund, they have actually followed the SEBI norms and there has been no problem in them at all. We must be having 40-50 ultra short term funds in India. Almost every mutual fund has one. There has been no problem in any of them. That is the proof of the safety of ultra short term funds. Even in the Franklin Templeton episode, hopefully there will be a very satisfactory return of money to investors. I'll come to that later when Deepak asks this question. One more lesson that we have learned is it has reinforced the value of diversification. Today, even in an emergency fund, formerly we used to say that there are some aspects of financial planning that can be done at the family level and other aspects have to be done at the individual level. For example, health insurance, one cover is enough for the whole family if it's a floater. Emergency fund, one emergency fund is enough for the family. Retirement funds, if both are working, then both have to have their own investment funds. General investment fund, if both husband and wife are working, each of them must try to have a general investment fund. But now, what we are saying is, even in an emergency fund, there is no harm if some part of it is done by the husband, some part of it is done by the wife in two different liquid funds of two different fund houses, just for diversification. So, God forbid something happens tomorrow, even in a so-called actively managed liquid fund, you're not going to be affected too much. So that's one more lesson that we have learned from this. Pavitra, I have finished on this. Has your question been answered? If you're listening in on this.
Yes, sir, it has.
Thank you.
Thank you.
I go to the dean of our college here, Professor Yonel D'Souza. So I'll start with him. As usual, he has got an impressive array of questions. We'll take them one by one. For a retail investor, a convenient way to have exposure to real estate as an asset class that has the potential to comfortably beat inflation is through REITs. Considering the upward direction of the equity markets, diversification in real estate, which is less correlated to equity, would provide stability to the portfolio. At present, there are very few options. Only 2 REITs listed on the stock exchange. Also, a recently launched fund of funds by Kotak investing in international real estate markets. I'll stop right here. Do not go for the Kotak fund. Very, very expensive, too expensive. It's a fund of funds. There are multi-layered, what is that called, investment charges to be paid. I would certainly not go for the Kotak fund of funds, but the 2 REITs that are Embassy Parks and some other fund that are listed on the stock exchanges, those would be, don't worry, those would be worth considering, no doubt about that. So, Yonel's question is, as retail investors, do we have to wait longer to get an exposure to real estate through REITs? Also, what would be a reasonably good REIT? What would a reasonably good REIT look like in terms of portfolio and expense ratios? Right, those are very good questions. Some of our investors who have large equity portfolios, we have just bought one lot of the Embassy IPO for them. Sorry, the Embassy REIT for them. We have not gone into it seriously, but definitely REITs in India are an investment avenue worth considering as time goes by. 2 or 3 things. To invest seriously in REITs in India, I would wait till we have at least 5 or 6 REITs, because we need more competition. We need more competition to drive down expenses and also to have competing performance parameters. So I would wait a little longer, and some very big investors, high net worth investors, as a little bit of diversification, you can go in for one of the REITs in India. But for a normal investor, no, I would not go at this stage. Maybe I would wait for another year or 2. I would wait till we have a few more REITs. What would a reasonably good REIT portfolio look like? I would like it to be diversified, and diversified across not just commercial, but also commercial, certain kinds of profitable residential business like service departments. Also, agriculture is slowly being freed, where other people also can come into the agricultural sector. In agriculture, there are certain high profitability areas like herbs, medicinal plants, aromatics. I do not know whether some companies are planning to venture into these kind of things, but if they are going to do so, it would be good. And also, one more issue is, just tell him that I'll take the call later in a session. One more thing is a bit of infrastructure like warehouses, like others, where we have a lot of not which are in the development stage, but where that whole infrastructure project has been completed, and now revenues are coming in. So warehouses, toll roads, where you are actually earning the income. Some of these things also could possibly be added to the portfolio. So real estate also, if you make a study, you can have a hugely diversified investment portfolio. You have a hugely diversified investment portfolio. So I would like a REIT that is big, that is very well diversified, that is big and diversified, and where the focus is on earning reasonably steady and reasonably high rental income so that it can be distributed, because there's the clause that 90% of the earnings have to be distributed after expenses. The other thing is expense ratio. Now, this is one question that I cannot answer, especially in India, because in India, there are so many expenses related to real estate. Right at the beginning, when you're actually buying real estate, you would have the registration fees that are atrociously high. You would have expenses of maintenance of real estate. don't think that low cost really works in this. Because there are hidden expenses. There can be damage to property, unforeseen damage. Having said that, when you look at it from the individual point of view, you know that for a normal middle class individual, any purchase of real estate is a huge deal. It is a huge deal because of the kind of money that you have to spend on a single real estate project. Whereas for a very large mutual fund, let's say that has got 10,000, 12,000 crores to invest, the economies of scale can kick in at this level. If I'm sitting trying to invest 50 lakhs or 1 crore rupees, I have several handicaps. If I'm sitting with a 12,000 crore cash corpus, all of which has to go into real estate or real estate oriented securities, then I can sit and do my study and my planning in such a way that I can have a very widely diversified portfolio of real estate, where I can have the kind of money at my command. I can beat down prices. Whereas a normal real estate developer, if somebody is putting up a commercial complex with, let us say, a large commercial complex with, let us say, 85 offices on about 10 floors, they, to be profitable and to really get everything, the whole value out of it, they have to make 85 sales. But here comes a large mutual fund that says, I'll buy your entire building, but it is at this price. So now the developer will have a cost benefit analysis. Where should I go? I save on marketing costs. I don't have to make 85 different types of sales, 85 different agreements, money coming in from it. Here, the money comes in one shot. How much can I go down? So many times there's a benefit for the developer. There's a benefit also for the mutual fund that buys it. The exploitation of economies of scale in real estate, I do believe, can be done by a real estate mutual fund. And that is the one single factor that would enable me to give the benefit of the doubt to the real estate mutual funds and recommend them as investments as we go along. Right now, for the little more sophisticated and little more high net worth investors, but later on, when there's a genuine opportunity, I think in the next 1, 2, 3 years, I think there will be an opportunity for all investors here. Yonel's second question. He has taken an example of DSP ultra short term fund versus the Chrysil ultra short term debt index. And he has shown how there has been consistent underperformance by the DSP ultra short term fund. Shouldn't you be happy, Yonel? Supposing it was the Franklin Templeton and ultra short term fund, there was outperformance. Yeah. And there was also a liquidity crisis. Okay, we walk a tightrope. There will be ultra short term funds whose performance is roughly equal to the index, others whose performance is higher than the index, others whose performance is lower than the index. The point is, there will be all kinds of things. The only solution to this is ultimately a ultra short or a bond index fund and more bond index funds. But I think in this country, they'll take some more time to come. But we, as an enlightened group, can make the case right from the beginning. Because right now, at least, there is acceptance of index funds on the equity side. So I don't see why we should not start making the case for index-based debt funds also. They are much more comforting. You will not outperform, neither will you underperform under normal circumstances. Until then, instead of being saddled with 1 or 2 underperformers, we will have to have certain amount of diversification across the top ultra short term funds. Size also matters here because many times when a fund has a reasonable size, That size enables them to pick bonds and dictate the terms and get the bonds at better prices. So we may have to look a little bit at size where debt is concerned. In equity, sometimes size can work against you, but not so at the very short end of the debt curve where there's huge amount of liquidity. But otherwise, the only way to tackle these kind of situations is, number one, through waiting for and pressing for index funds here also. And number two, by diversifying, so that all your money is not in the top performing fund, all your money is not also in the bottom performing fund. Then the next question. There are about 8 crore folios investing in equity and hybrid mutual funds. It is said that India is under-penetrated when it comes to investing in equity, direct or through mutual funds. Assuming the government somehow nudges its citizens by subsidizing investment in equity through a pension scheme or a citizens' provident fund that increases the number of investors by 15 times and the market capitalization by about 5 times. In this case, more, and that too consistent additional inflows by new investors will take the equity markets to the North Pole. Under-penetration is one side of the coin, but what are the areas where the emphasis needs to be placed to create more opportunities and space for the new investors in the equity markets that wouldn't lead the markets to getting overheated? Okay. What Yonal is asking here is, supposing the government comes out with such phenomenal incentives that people suddenly abandon their bank deposits or prematurely liquidate their bank deposits and dump all their money into the Nifty and the Nifty 100 and the Sensex, and the markets take off like a rocket, wouldn't this be a problem without a corresponding increase in the economic opportunity that you have to invest in? Something like what Gopal was asking, we have a 40 PE situation today, absolutely unreal situation. But let me answer that question in a very simple way. These kind of questions are always asked. They have been asked throughout history. What if we have a situation like this? One of the questions that are always asked is, what if everybody indexed? My simple answer is, if everybody indexed, it will be very good, because then stock market investing will be simple mathematical calculations like bank fixed deposits. And at that time, you will have certain people who will be fed up with it and who will come back into active investing, and they'll probably beat the markets, because a totally indexed market also could be inefficient. So there will be people who avoid those inefficiencies, and you will once again start the whole cycle of access passive. But that's a bit of a
one point to add. There will be a liquidity crisis in the equity markets.
Liquidity crisis. Yeah. Yes, if everybody puts everything there and there is no further money. But my point is that such situations, you may have a touch of the unreal, but the whole world does not become unreal at the same time. So let me answer the question this way. These questions have always been asked from time to time. You have another question like the one you asked. What if there is a flood of money into the capital markets? Let me give you a bad situation and a good situation where these things have already happened and they did not affect the markets at all. Let's take the bad situation first. The younger people here will not even know it, but the slightly not so young people like Gopal and me will remember that back in the days of Indira Gandhi, the 1970s, we had a 97% tax rate in India, the marginal rate. The highest taxpayer would pay something like 97% or 98%. So above a point, if you're earning a lakh of rupees, 97,000 rupees you leave at the doorstep of the income tax department, and 2,000 rupees is 3,000 rupees is yours to do whatever you want with it. So we had a situation where this was not taxation, this was theft. And that's why this made India the #1 black money country in the world, because nobody is going to surrender 97, 98% of what you're earning to the government. So you do the other thing, you create black money. Second thing which many people are not aware of, there was a dividend ceiling. I think the dividend ceiling was 7%, if I'm not mistaken. A company can make fabulous profits, but you cannot pay more than 7% dividend. There was this situation actually in India in the old dark days of socialism. The young people here will find it difficult to even believe this, that such a thing could arise. Even in these situations, you would have thought that people would have completely the opposite of what Yanal is asking. Forget the stock market, Bombay stock market exchange closes. Nobody will invest in stocks. You would have thought that such a situation would arise. Didn't happen. People who had to invest in stocks, invested in stocks. Some people would have gone away, certainly. Significant people also might have left. But there were people who continued. The stock markets did not close down, even in these dark days. Now let's come to the bright thing. Tax on dividend was abolished in the hands of the investors. And in 2004, long-term capital gains was abolished. Can you think of a bigger incentive? Investing became tax-free, totally tax-free. No tax on dividends except the distribution tax, but it's all right. But more than the dividends, it's the long-term capital gains, which really make a difference to an investor. And long-term capital gains, you do not have to pay one pi. That securities transactions tax was so negligible as to be completely, ridiculous. So we can forget about that. It was essentially tax-free. You can't think of a better incentive. People did come, but 15 times, 5 times jump in market capitalization, 15 times the number of the kind of figures that are there in Yonal's question did not happen. Forget about 15 times. You can have the best nudge in the world. You should be thrilled if instead of 15 times, forget 15 times, if 1.5 times things happen. So understand that these kind of spectacular questions can be asked. But there is in probability theory, and if you read Nassim Nicholas Taleb, you'll have answers to these kind of situations. There is something called the law of large numbers. We think that if they say tomorrow that once again we are removing long-term capital gains tax from equity investments, the markets will jump. No doubt about that. But by how much? If there are 5 crore equity investors today, if the kind of multiplier that you used 15 times, will 5 crore investors become 75 crore investors? I will be shocked if 5 crore investors become 7.5 crore investors. Forget about 75 crore investors. I will be shocked. And that too, 5 crore becoming 7.5 crores may require 5 to 10 years. Not 1 day or 2 days. It will not happen. The law of large numbers says that just as there are some people who will react to even a positive happening which is rare, a significant positive happening, there also will be a huge number of people who will show nothing but inertia. So when we say 5 times market cap, 15 times somebody coming in, no, not 15 times, not 5 times, even doubling will require a tremendous effort. So just because there are incentives, it does not mean people will go into equity. Things do not move as expected or at the speed that you expect. If markets have to boom and collapse, the underlying short-term factors are only greed and fear, not government nudges. Let me tell you that. Greed and fear. Greed can propel a market upwards and fear can bring a market downward. Bitcoin is a good example. The 2003 to 2013 real estate boom here. So many people were asking me at the height of the boom, shall we go into real estate? Shall we go to real estate? I can buy it now, I can sell it after 6 months. I said, you can do that. But you are asking me the question to do that after 9 years of the boom. Okay. So this may not be the right time to do it. And then, of course, it was followed by the last 7 or 8 years of recession. So if you are talking about something that will propel markets upwards or send them crashing down in the short term, it is not government nudges or incentives or changes in the law. It is more likely to be simple greed and fear that are very powerful influences in the short term. In the long term, you could have a slow and steady, average or sometimes slightly above average participation in the equity markets. But those factors will once again not be nudges and incentives as much as simple sociology. If economic policies enable more and more people to prosper, if the GDP goes up, if the per capita income goes up, if the predominant portion of the population now becomes the middle class, if a lot of people who are poor come into the lower middle class, a lot of people who are in the lower middle class come into the middle class, a lot of people in the middle class go slightly higher than that. If this kind of thing happens, then in the long term, there will be perhaps an above average growth in people's well-being, financial well-being, and that will be definitely reflected in the financial markets, in their standard of living, in all these things. A good example is what has happened to China in the last 3 decades or so. Chinese stock markets, of course, are not mature because the state interferes too much in it. There's no truly free enterprise there. Think of what has happened to Jack Ma at the moment. But there is no doubt that a huge number, hundreds of millions of people have been lifted out of poverty in that particular country. So these changes are gradual. All these kinds of things are very nice to read, very spectacular to read when somebody comes out with a newspaper article, but the changes themselves are not so spectacular when they happen in reality. And the last question of Yonil: if the investor wishes to access KYC data, is it possible to do so? Not to my knowledge. Not to my knowledge. The only thing that you can do is go onto the cvlkra.com website and check the status of your KYC. That you can do. They will ask you to put in your PAN, maybe one security question or two, a CAPTCHA code, and then you can check the status of your KYC, where you have reached. But KYC data, actually, what have I put in my application form? What has happened? No. In our office, what we do is each and every new KYC form and each and every new KYC modification form, a scanned image is retained by us. Because tomorrow, if there is a mistake, then we have here proof. No, we submitted this. You have made a mistake, you correct it. If we have made the mistake, we will correct it. No problem about that. No problem about that. So this is the only data, our own data, that we can access. We work at 2 levels. Whatever has been submitted, we also keep a copy. Second thing is, whenever it is submitted, in whichever form it is submitted, that acknowledgement, if it is physical form, physical acknowledgement, that somebody has received it, we store that acknowledgement also. And your last question: ideally, the objective of CKYC is uniformity and interusability by all financial entities across the financial services sector, correct? Does it practically happen at banks, insurance companies, NBFCs, etc.? No, it doesn't. Even today, even in the days of centralized KYC, a KYC that you have done, CKYC that you have done for mutual funds will function for equity. But what you have done for mutual funds and equity will not function for a bank, to the best of my knowledge. Need not be too worried about it. It does not happen today, but we may be moving towards that. We'll know in the next 1 or 2 or 3 years. Your 3, 4 or 5 questions Have I answered them, Yonil, or anything to be anything
Yes,
pending there?
No, it's answered. Yes. Yeah. It's
Thank
clear.
you. Thank you.
Thank you.
Deepak. Deepak is with me, so he'll ask the question.
What is the next step for these six debt funds?
Okay. All of us must be abreast of what has happened at the court hearing yesterday at the Supreme Court. The various parties were present. Franklin Templeton, I think, was represented by Leo Amal, along with Harish Salve. But what has happened is the court has taken cognizance of the fact that 95, 96, 97%, whatever it is, of the investors, an overwhelming majority has very sensibly voted in favor of winding up. And here, some credit has to be given to scoundrels like us also, because even the distributors have put in a pretty serious effort in for once helping investors to arrive at a sensible decision, guiding them correctly, even helping them in updating their emails and other things, ensuring that in cases where they did not receive the e-voting notice despite their emails being registered, re-registering, sending them that, helping them to ensure that they cast their vote when the time came. It is not easy to achieve this kind of a result. It's not easy to achieve 96, 97% voting in favor. And somewhere, despite all the controversies that have surrounded that voting process itself, despite all that, the vote has taken place, and the vote is very, very clear that the normal investors want winding up. One more good thing is, when you look at sheer numbers, we had about 3 lakh investors who were affected by the winding up of the 6 funds. To my knowledge, some 9 or 10 or 11 investors have gone to the court. You take even 10 or 11 investors and divide them by 3 lakhs, what's the percentage? Okay, so these were, the court has rightly remarked, I read in one of the reports, the court has remarked that a tiny number cannot affect the process or affect the interest of the overwhelming majority of investors. Now, the overwhelming majority of investors would have also perhaps liked to go to the court, not so much as against Franklin Templeton. They might have wanted to go for an orderly winding up. But like I said, in the law of large numbers, which we discussed, there is a lot of inertia. We think there is no inertia, but the number one factor there is inertia. So they did not go, and maybe they did not want to spend. Or maybe, let me tell you this, maybe among the people who have gone to court, there were certain vested interests. There were certain vested interests, and there were certain underhand motives also among some people. I have no quarrel with a genuine investor who panicked and went to the court. I have no quarrel with that. But there were certain organizations and certain other people who have gone, and the investors did not have the chance to, the genuine investors, the vast majority of investors did not have the chance to approach the Supreme Court. But the Supreme Court beautifully gave them a chance to appear before it by saying, conduct a e-voting, have an observer, give us the verdict in a sealed envelope. And the court has been quite transparent by publishing the figures. So this has been done. And now a very short adjournment has been given from the 18th of September to the 25th of September. Now, on the 25th of September, the court, as far as I know, Leo is, I think, if Leo is on this call, he can correct me if I'm wrong. Or if he has anything further to say, he is most welcome to say. But if I'm not mistaken, Deepak, the court has said that while we will consider all objections of all parties, we cannot disregard the will of the majority here. And this is not a simple majority. This is a 96, 97% majority. So the interests of these solid investors who have voted very, very clearly and unequivocally in favor of winding up. The court has said that we are going to give this due due consideration, due weightage, and I think the thrust is going to be on the winding up process, on directions for winding up, so that money can be returned to investors at the earliest, one way or the other. The only other thing that I would like to tell you is that you know better than me, because you would have been following it up, so do investors, so do the distributors, that with each passing fortnight, the situation of each and every fund is improving. That is a very good thing. I still remember one sentence in the very first communication when winding up happened. On that day, there was a communication from Franklin Templeton. And that communication said, we assure everybody that the underlying securities are sound and conservatively valued. They are sound and conservatively valued. Now, I will confess that I myself did not believe Franklin Templeton that day, because it was totally something unexpected for me also. That a fund like this, group of funds like this, including something like ultra short bond fund, can go under like this and be wound up. But when I saw that line, I had read every word of their communication. I was wondering, will any mutual fund put this in writing, because it's sent to everybody as a communication from the president, Sanjay Sapre, and Sanjay Sapre is saying the underlying portfolios of these funds are sound and conservatively valued. That was a true statement in hindsight. Now, not just hindsight, but in the light of the 9 or 10 months experience that has passed, yes, there would have been one or two investments that would have turned bad. And just because they have turned bad, it does not mean that there are no recoveries. You may be able to recover. Even in the future, they may come in small installments. But the overwhelming majority of the securities in the portfolio are sound. They have been conservatively valued. Vodafone is a very good example for conservatively valuing something. It was valued at 0 and recovery was 100%. So that is conservative valuing. And everywhere, low duration fund, 64% in cash today. Ultra short term fund, 50%, shade over 50%. Some other fund, I forget the name, 40 odd percent. And every fortnight, we were a little worried about another old good fund called the Short Term Income Fund, FISTIP, Franklin India Short Term Income Plan. But that also has done away with its borrowings and turned to about 10% cash. And hopefully there will be inflows into that fund also. And if there's an orderly winding up, there should be very good recoveries, because we are holding securities that are some 12%, 13%, which are very attractive in today's market to dispose of. I will stick my neck out and say that if orderly winding up is allowed, and so far for 10 months, Franklin Templeton has had its hands tied behind its back. It has not been able to take any active measures. If they are given active measures, I think in outer limit, I don't think they need so much, but outer limit, 6 months time, everything will be over. 6 months time is only in some funds. In funds like ultra short bond fund and low duration, I think the whole case will be over in 2 to 3 months. If Leo is still on this conference and he has anything to add, he can go ahead.
Hi, sir. Nothing much to add from my side, because most of the things you yourself have covered it beautifully, sir. So, as you have mentioned it rightly, you have told the outer limit, but that's what, especially in schemes like ultra and low duration, yes, of course, sooner than what people are actually thinking, it will get over, sir.
Correct. I completely agree with you. And after this, no more talking about Franklin Templeton, only about Leo's party. Right. Deepak, anything else? Yeah. So I don't think we have anything to do, Deepak. We have just got to sit and wait and hope that there will be. So far, Supreme Court has handled it brilliantly. So we hope that this continues. And the chief judge on that bench now, there has been a small reconstruction in the judges. Justice Abdul Nazir. I hope you know that he's from from Karkar, from your place, and he's a very fine and upright judge. Very fine and upright judge. And Justice Abdul Nazir's general outlook in judging is to try to ensure that justice is actually done. And he is always very sensitive to the interests of large numbers of people. So it's a beautiful thing. Here there are 3 lakh investors. And so all those investors also should be happy that ultimately in the Supreme Court, their case came up before a judge like this. Even Justice Sanjeev Khanna, who was on the bench, he's a very pleasant and very good judge, intelligent judge also. Once again, sensitive to the interests of the actually affected people. I do not know who the 2 new judges are who have come there, and I do not know much about them. But so long as Justice Abdul Nazir is there, I'm sure all of them will judge an issue like this with wisdom. And therefore, the 25th also would be an important date. And we hope that a decision will be taken. We don't want in anybody else's interest, not in the interest of the distributors, not in the interest of the mutual fund itself or the trustees, but I hope the judges continue to come out with a judgment solely in the interest of the investors.
So one more thing.
I'm sorry.
And here, from now onwards, I believe I am not the only person from Franklin Templeton to represent here. So we have Basavaraj also here.
Oh,
so
if Basavaraj also has something to add, he is most welcome.
Yes, sir.
Sir, hi, sir, and good evening to everybody in the group. Yes, sir. Happy New Year to everyone. I'm sure, sir, you have covered fantastically. I'm really thankful to you. You have covered most of the things. I have really nothing to add from here.
Okay.
Sure.
Okay. Anyway, good you were there in this. So
Yeah,
I
thank
will
you.
hand back to Yonil. If there are any other questions, I'll deal with them. Otherwise, we will call it a day.
So interns, if you all have any questions, you can unmute and ask.
Gerard, I just got a query. So, with regard to health insurance.
With regard to?
Health insurance and personal accident cover.
Yeah.
Okay, let's say a family of 3 in Mangalore have a family floater of 5 lakhs plus another 20 lakhs as the super surplus. So, let's say they have 25 lakhs. Do they need a super surplus or top-up policy?
Right.
But they have total of 25 lakhs now. Do they need a personal accident cover? Or accidental hospitalization is covered under this. Sorry, I'm not.
Hospitalization for treatment because of an accident is covered, very definitely covered under the basic cover as well as the super top. Personal accident is only for loss of income during that period. It would depend totally on what kind of work that person is doing.
Because these days they've come up with the companies like Star Health, they've come up with the family floater personal accident policies as such.
I think this question should not be asked to me. It should be asked to somebody. Is Sukanya or...
Yes. I'm there.
I would like you to answer.
There is some disturbance.
I'll just
There is
switch
some
on the
disturbance.
light. I'm looking very dark.
No, there's disturbance. Yeah, could you please unmute? Sukanya, could you please unmute?
Yeah.
No, there is some disturbance.
It's the fan. I'll just switch off the fan. Okay. the disturbance still there?
Yes, yes, it is. Now it's, yeah, it reduced. Yes.
Okay. Yeah. So personal accident covers only accidents. So they have come out with a plan because the accidents, road accidents have increased.
Sorry
So
to
there is
interrupt, but the disturbance is still there.
Is it there? Not sure. Just a minute. Is it there now?
Yes, yes, but,
Is it there now?
you're audible. It's okay.
You're audible now. You're
Yes.
audible now.
Okay, because I don't know why the disturbance is there. Yeah, the personal accident covers only accident. It gives you a lump sum if there is a permanent disability or in case of death. So sometimes what happens is if there is an accident and if the earning member loses his limbs or is bedridden or something like that, and then you don't have an income for the family. So in case of personal accident, you get a lump sum amount, so which can be invested, and then the family can live on that earning. So and in case of death, that policy can be continued for the rest of the members. So that is why they brought out this personal accident family floater also, and the price is very low. So that is why they're aggressively selling it. And one thing is, again, mortality, probably the probability table in case of mortality is much lower. So they can earn more rather than because Star Health sells mostly health insurance and then travel insurance. So in case of this personal accident, probably their profitability is higher. That is what I'm thinking. But apart from that, yeah, you may need it because there are accidents now. I mean, you could meet with an accident. So that is the thing. So anyway, it's your choice. It's your call to whether to have the personal accident policy or not. So that way. And in case of health insurance also, many times they check what kind of profession you are in. But in case of personal accident, generally they give it to anyone. So you might have a higher risk, like something like plumbers or people who work in hazardous occupations. You can still buy a personal accident policy, so they get a lump sum amount. So that way.
So do you still recommend, let's say I gave you the scenario of say 25 lakhs of health cover. Do you still recommend a personal accident for the family or for the earning member itself?
No, only the earning member. I would.
Right?
Yeah.
Okay. Yeah. Just that. Yeah. Thank you so much. Thank you so much.
Yeah. Is the disturbance still there?
Yes, yes,
Yeah.
yes.
Or
Now it goes up.
Yeah.
Yes.
It's off?
It goes
No,
off and on. Yeah.
Oh, okay. I'm not sure. Maybe because of the mobile disturbance, I think I kept it away, but probably because of that signal.
Okay. Possibly. Interns, if you all have any questions. Yes. Yeah, I don't think there are any questions any further. Yeah, thanks a lot. Thank you very much, Gerard, for spending your valuable time with us.
Yeah, I also thank Yonil. Thank you, as usual, for organizing this so beautifully and collecting the questions, collating them, sending them, and also, of course, to Deepak Rao and his new camera here, and a very, very comfortable soundproof studio from which to speak. It's really a pleasure to come here both to teach as well as to speak. So thank you all. I'll be leaving now because I've got a little work to do. Okay, see you next time whenever we have our next session.
Yeah, thank you very much. Thank you.
Bye.
Thank you, sir. Yeah. Thank you, Anil.
Yeah, thank you.
Bye.
Thank you, Anil. Thanks, sir.